LinkedIn, YouTube. My name is Andrei Yurkevich. I'm founding member of Portofire. And today we're speaking about lending markets, what it takes to build and run a lending market, what various members of the ecosystem expect from lending markets, what does the lending market define in the DeFi ecosystem in general. And we have awesome panelists today representing retail credit products, lending marketplace, and two blockchains, Midnight and Pharos. Actually, the participant from Pharos did not join us yet. Hopefully, they will be able to join a little bit later. But if not, then this side of the market will be awesomely represented by Midnight. So we'll start with the questions that I prepared for the audience, and then we will have possibility to take questions from the public. So please reply to a social media post in the channel that you're using, and if we have time, we'll be happy to answer your question in this session, or otherwise we will just answer your question later in written form on Twitter or X or YouTube. All right, guys. So let me give a chance to our panelists to introduce themselves. Let's start with Gareth from Midnight.
Thanks very much, and great to be here. My name is Gareth. I'm from the Midnight Foundation. We're an L1, privacy-focused L1, and sort of my role within Midnight is to grow the ecosystem. And within that growth of the ecosystem, obviously there's everything from various programs, from investments, from supporting partners, looking to sort of scale and understand business models. But one of those aspects is around on-chain credit infrastructure, and how do we look at this lending aspect to scaling the ecosystem of Midnight. So that's me and my role.
Awesome. Thanks, Gareth. Mohammed, would you like to go next?
Yes, my name is Mohammed Salman, and I'm the founder and CEO of DeFi by InvoiceMate. We are not just a lending protocol. In fact, we have an end-to-end stack that complements the lending operations, starting from the origination to the very important part of the due diligence, and then the permission vault-based DeFi as a protocol that basically connects to those verified deal flows from the real-world assets, mainly PayFi and TradFi, and we connect them with the Web3 stablecoin based investors. So based in Dubai, and have been live for last 3 years plus.
Awesome. Thanks. Luis?
Hello, I'm Luis Medeiros. I'm the CEO of ArenasFi. It's a startup that is part of the Protofire ecosystem, and started as a joint effort of Protofire and Aave Foundation to democratize credit and connect DeFi lending with real-world asset originators. So we are building this infrastructure that connects large lending markets like Aave, Venus, Morpho to borrowers in the real world. Yeah, happy to be here.
Yeah, thanks, Luis. Ale?
Hey everybody, so Alejandro here, Ale, for the ones that doesn't want to pronounce it in Spanish. I'm the CEO and the founder of Fuero. So Fuero aims to be the uncollateralized credit solution for bringing prime borrowers into on-chain without having any collateral. So what we try to achieve is basically a bridge between the credit black box that exists in TradFi and bring it on-chain, basically. There are some initiatives right now, but no one did it like with this full premise or under collateralized, no collaterals. So this is what we are doing. And thank you for having me today here.
Awesome. Thanks, Ale. Ren, thanks for joining.
Hi, glad to meet you all. I'm Ran. I'm from Pharos. So basically, Pharos is a inclusive financial layer one, and we're trying to bring the high quality real world assets on chain. we've actually launched on Midnet and also listed on major exchanges in the late April. So basically, we have onboarded like a 15 million worth of consumer credit product in RWA Vault, and we're trying to build more of this kind of Vault product and include a variety of different RWAs like money market funds or stocks or PayFi or BTC-Fi and all kinds of products that may generate yields for the users. And also, we're trying to create the DeFi applications around those RWAs. So we are onboarding lending protocols like Morpho and Termax on our chain. And also, we have DEXs like Bitverse and FaroSwap. So those are native DeFi primitives on Faros. Yeah, so great to be here, and yeah, wish to uh, discuss about the lending and all the DeFi uh, products in this space with you guys. Thank you.
Yeah, awesome. Awesome. Thanks for joining. So yeah, I will ask my questions to the whole audience, or maybe I will direct it specifically to some of you guys, to Mohammed, or to Ran, to Gareth. So if you want to speak, if you have opinion on the topic, please feel free to raise your hand, so we can speak in terms. All right, yeah. So let's get it started. And my first question is: lending is essentially one of the pillars of the finance, right? And we already have a slew of notable players like Aave, Morpho, Maple. We can put the CDP category in the lending category in category as well, right? We have Sky, we have Liquidity, we have RWA backed. So my question to you guys: what are the use case that we can say that are well defined, that are rock solid, we can rely on them, and we can continue building on some primitives that already exist in lending? So who wants to be the first one to take this question?
Yeah, I can
I
take
can.
it. Okay,
Okay.
go ahead, Mohammed.
All right, thank you. So, just to like again, for the audience sake, there are always in the world of finance, there are three rails: payments, lending, and then investment. So, yeah, we are talking today about the middle one, which is also a critical rail. So, it's built on the payment rail. So, there has to be a foundation of finance running on some payment rails. So, in crypto also, we have seen that most of the early projects were solving that problem: remittances and value exchange. So that payment rail got set up, and let's say 5 years back, that was pretty much there. Yeah, every day it's getting mature and further mature. Then came this lending phenomena, that this rail had to be there, and we saw that evolution starting in probably post COVID 3 odd years. But it went to into the initial days, it went into the direction of over collateralized crypto as a digital assets, and that was the direction of the Web3 finance at that time. Last couple of years we started hearing about RWA finance side, or lending side. So I'll be, because my space is that, so I'll be trying to give more insights on that side. And especially, as you are asking, is there a requirement of a specialized lending protocol? Definitely, because lending happens in multiple ways, for multiple reasons, for multiple audience or clients. So one size cannot fit every thing. So it has to be a specific protocol or specific project that is catering the problem of that one lending type. So in our case, we take the receivables as a collateral, or as a something where we built that as a blend for the lending protocol that brings yield to the Web3 investors. And on the other side, this solves the problem of the receivables, cutting early settlements for payment networks in a PayFi space, and for the businesses in TradeFi space, traditional finance space. So this requires a very specific set of rules, operations, onboarding, and then investors are also are not generic. They are also specialized, who want the yields in this side. So these are the things which, of course, in coming on up, I'll keep it short in this answer, but we'll express more about the insights in this particular domain of lending. And cutting my answer now short to the point that every type of credit lending requires a specific protocol and ops and other like procedures.
All right. So I don't see the hands. Where are the hands?
So Ali
Show me,
can
show me
go.
your hand. Yeah, Luis,
Yeah.
please.
Go for it, Ali.
Yeah, I have some construction workers right now over me, so if you can go next, that would be
Yeah,
awesome.
sure. Yeah, to answer the question on the DeFi side, right? I think the base things that we started doing with lending, like getting leverage or like loop strategies, right? Getting more exposure to ETH or BTC or other assets, and then the also a easy way to get some small yield compared to what people use it to do on dexes, and it became a little um, complex to do with after univ 3. So you use we use it to have these two kind of main uses for the lending markets, and also of course native assets of chains being used as collateral there. I think those use cases are quite already battle tested, despite of the like kelp DAOs as problems that eventually can happen. But I think the infrastructure and the technology for this base use case are there, and now we are evolving to things that are more connected to the real world, right? Using this liquidity to serve real purposes, not just DeFi yield.
Yeah. Now I can go next, I guess.
Yeah, please.
So, yeah, I feel it's undeniable that over collateralized money markets already solve like a big need, right? The access to a lending product, but it's kind of, I do believe that what it's, maybe I'm biased because of what we are trying to build. I want to do the opposite, right? I feel like the market already has like the collateral, having the trust in order to like have a lending for an anonymous kind of counterparty, right? So what we want to do is the opposite. We want to know the borrower, so we don't need to trust on the collateral, so we can give this lending. So this is kind of my vision, my best vision.
All right. Gareth, Ren, any opinions?
Yeah, so actually, so our approach is quite similar from a point of that trust. So with the variety of different lending, sort of lending LPs, etc., there's we're trying to look at it from more of the institutional side. What would unlock all that institutional LP to come into the lending market? And with the adoption of so many different types of RWAs now, the compliance side for us, that trust side, is quite an important layer. Ultimately, you want to be able to identify who the person is or what the asset is, and the trust of is it an asset which can be sort of lent against. So from our perspective, we're trying to do that, and transparency sometimes isn't the solution, but the trust is the solution. And so we're looking at from a very much a privacy side of being able to selectively share certain bits of information to validate and verify that the asset or the person, the counterparty, is viable for that lending. So we're very much looking at that side, and the privacy side and the compliance side for that is, for me, the big focus around how we unlock all that institutional LP.
All right. Ren?
Gotcha. I may briefly share my idea. Yeah. So since I've mentioned that we were working on the database, so using database as a collateral is slightly different from native crypto assets. For example, like sometimes they don't have a DEX liquidity, and also some of the database they don't really have a Oracle price feed, and also some of the fixed income product has a duration. So you cannot actually withdraw these assets from the platform immediately. So that's actually the reason why we are onboarding Termax as the one of the lending protocol on Pharos, since they are offering this kind of fixed term lending market and fixed rate thing, which is suitable for other base. So for example, for the consumer credit product I've mentioned, it has a 3 months lockup. And basically the price of this product is basically the NAV of the credit product. So Termax is including this token P alpha as the collateral and allow users to borrow USDC against the P alpha token. So with Morpho or with other lending protocol, actually we cannot include such a product as the collateral. So I believe for other big assets, actually we need some innovation in terms of the lending protocol. Yeah, so I can share more details about this product later. Yeah, but just want to mention about this point. Yeah. Thank you.
Awesome. Thank you, guys. So my next question is for Ren and Garrett specifically. I was always curious how you guys in your ecosystems decide what workloads you land on your blockchain. So, for instance, if Luis comes to you and says that, "Hey guys, I want to deploy a lending market on Midnight or on Pharos," um, what would be your reaction? Will be, yeah, hey Luis, the documentation with permission, let's just go deploy, or yeah, Luis, how can we help? Anything that you may ask, and essentially on the scale from let's say 1 to 10. Now the lending market workload, now where it sits in 3, in 7, in 10, in 5, and what probably the KPIs that would trigger something on your side when you have a lending market. I mean, well-performing lending market, right? So how would you treat this situation? Yeah, Gareth, you already have your your hand raised, so yeah.
Didn't realize it was still raised. Apologies. So we look at it from a purpose of what are generally the assets you're trying to lend against, and from our perspective, we want to figure out where the interest lies from our ecosystem. Like if we want to drive more value from the ecosystem and sort of drive sort of adoption and then sort of flow through the ecosystem, we are trying to look at everything from the utilization of the asset, what is the rate for the asset itself, what's the liquidity aspect of the asset, is it locked up for a certain period of time, the privacy and transparency of what is the underlying asset that we're able to borrow against. We look at the compliance side as well. So from our perspective, it's very much take quite a holistic approach of how we can sort of drive from an ecosystem adoption to sort of generate the most from it. Our focus is primarily around the privacy side. So we would say, how can we build in that privacy aspect to this work? Because when we're speaking from our perspective, from those institutions, their whole mandate at the moment is quite strong in the market, is around privacy. They are very keen to know, well, we don't want to disclose all the information, but we want to basically to offer from a compliance standpoint this the ability. So we're building these solutions around this privacy and this compliance standpoint, and that's what we are very particularly interested in. Like it, say, if Lewis was to come to us saying, okay, let's discuss how we build this compliance side on the top to be able to offer it to our LPs and to offer it to our ecosystem as well.
Okay, thank you.
Yeah, thank you.
Yeah, right.
That was great. Yeah, so from Pharos standpoint, I think we're trying to create basically a looped version of assets. So for example, like many of the public chains actually to incentivize the projects is highly relied on the USDC subsidy or the subsidies in platform tokens, right? And sometimes, all the chains are competing on the incentives. So for example, this chain gives out 1% additional APY, other chains give you even more, and the project will choose the one who is giving out the higher incentive. So from our standpoint, I think we're trying to use, the lending and looping strategy to replace, this kind of subsidy sort of policy. For example, like take the consumer credit product I've mentioned before. So the yields of it is 14%. And if we create a lending market for such a product, basically the borrower, they are willing to pay, for example, 9% to borrow against these assets. And once they receive the USDC, they can actually reinvest in another RDB vaults that generate 14%. So basically, those products are existing on Pharos now. There is a real estate vault that generates 14%, right? So basically, if we are creating a lending market for this consumer credit product, we will be able to allow the current existing LP to borrow against it and reinvest in another real estate asset product, right? And basically, the looped yields for this LP would be, for example, 16% rather than 14%. And in that way, basically, as Pharos ourselves as a chain, we don't need to pay 2% additional APY in our own cash or our token, right? Basically, we create this kind of DeFi application and maximize the yields for the LP with the lending market. So this is something we're trying to build. So when we are onboarding our lending protocol, I think first of all, like we want to see if it current infra and the solution could take RDB as as a collateral, and also like we'd love to actually liquidity I think is a very key issue. So if they can bring the LPs who may provide the USDC side with love to work this kind of lending protocols. Yeah, so yeah, I think our key focus is RWA and also liquidity, and trying to create this kind of looped vaults and looped product for the LPs. Yeah, I think that's our major focus right now.
Okay. Yeah. So, Luis, for arenas, for your perspective, how do you make the opposite decision, right? How do you make decisions, or how do you choose the platforms that you would like to deploy arenas?
Yeah, I would say it evolved a lot, and the way I see chains these days, it used to be a discussion around technology, right? This chain is faster than this one, and then this one, how distributed is the sequencer. So but now I see it more like ecosystems, as Garrett and Ren were describing. What are the real borrowers or the originators that the chain is able to aggregate or to bring together, or to create a narrative around something that is different, right? We're in talks with a chain that is focused, for example, with on Litecoin ecosystem that's underserved, or you get a specific niche, and if this chain is able to get a decent amount of borrowers, then the yield is coming from there, and this is what liquidity seeks, right? Liquidity will always seek the best yield, and that's why we on arenas we're trying to be this mid layer that will, for example, bring liquidity from Aave, from mainnet, into a chain that has the borrowers, so they don't have to compete actually, right? Those both chains would be profiting by one by bringing the originator and the other by bringing the liquidity, and that's why we are focusing on chains that have are building these real ecosystems of borrowers that are meaningful.
Okay. Yeah, and the next question for Ali and Mohammed. Do you guys really care about the underlying infrastructure, right? And what if you for instance interact with Morpho or Aave or Liquidity, right? Now, do you care about what blockchain it deployed on, and how it influences your decisions? So who wants to
Right.
go? Mohammed, yeah, go ahead.
Yeah, I can go first. Yeah, the two parts of the question. So, yeah, first, which chain we would prefer to roll out the products which we have, like the RWA based yield products. So, number one concern or consideration is always whether it's like enterprise focused. And I say enterprise focused. So, of course, Midnight and Pharaohs can I can vouch for them, because they are. It's not that always a transparency is required, especially in the business, real world business. You have to be very selective what information you can public, what information, like the client information, the deal flow, transaction numbers information. You cannot expose it to the on a public chain to everyone. So you have to go with the selective kind of a information exposure for the ecosystem, and that is required. Not every chain is enabling that, so there are enterprise focus, I call them enterprise focused chains. So yeah, these two are also like are among the two, among the like selected few. We have Plume in the same direction. We have now Canton pursuing that same genre. So this is obviously the preference number one. The second one is obviously the, as Luis was mentioning, it's about ecosystem now. It's not about just technology. Yeah, technology is important. It has to be reliable and of course relevant to your product or project. But at the same time, now the ecosystem support means that are is the foundation of that particular chain, is enabling you to have the community engagements with their, I mean with engagements with their community. They are enabling you to meet and connect with the LPs in their community, institutional LPs I'm talking about. So this is also these days almost a given thing that any project who wants to be on a chain has to see where is the ecosystem support. And certainly in our case, the grants and these kind of petty ecosystem enablements, which probably are good for the early stage projects, but for the, if you are really looking for a growth, then grants are not, is not the one thing which you need to see. You need to see how overall that um, foundation or ecosystem is going to enable you for the business growth. So these are the major two elements: technology relevant, and of course ecosystem support when we go for integration with some chain.
Good one. So yeah, I'm pretty much aligned with Muhammad and for sure with Luis. I feel he's 1000% correct when, so as a builder, I'll first of all, do I care about the infrastructure that is behind like this blockchain? 100%. Like why? It's not the same having 1,000 TPS rather than 10,000. It's not the same being compliance ready or not. It's not the same if you have like real world assets, for example, listed and the whole loop, right? Like the strategy managers, the creators, that all this. Um, but okay, so but the second thing as a builder that I really look up to is distribution, right? So at the end of the day, we all have like, at least these builders have this distribution mentality. How many people can I affect? And what Luis was mentioning again was very clear to me, which is okay, what is the micro niche that I want to address? In my case is prime borrowers, right? What is the chain that has more to do with them? What is the chain that has more infrastructure around them, like for me to be compliant with the sec and all this stuff? So yeah, these are my two main points that I look up to.
Yeah,
If
Luis,
I
you have
can,
a full thought.
yeah, if I can just add one thing that's more spicy point, like I had a
I like it
conversation.
spicy. I like it
Yeah,
spicy.
yeah. I had a conversation with the chain that is trying to push real world assets. It's a large chain, and they, and then we asked, okay, I what do you on the right end of this risk with part of your treasury, right? Are you really like, do you have skin in the game? And this, oh no, no, our treasury, we keep it very, very, very safe, like very small yield, but very safe, right? So I also value chains that are kind of eating their own dog shit, right? Like they want the dog, they want to have some skin in game, get and participate, because not in a big level, right? Like we don't need to have all the your treasury at high risk, but part of the portfolio, because it gives us important signal to the whole ecosystem, to LPs, and to even to retailer users. Okay, the chain is going there as well. They assessed the risk as well. So it's important for the investors that they see many underwriters participating.
Agree,
Yeah,
agree,
Gareth,
100%.
please.
Sorry, yeah, just there's a couple of points there I thought was quite interesting. So, I agree with you. It's important to have skin in the game, and sort of there's an aspect about getting more from the sort of the foundation from our perspective really to support and be part of it. But one of the key aspects that we're pushing was we take an approach whereby we don't just want to give an extra bit of incentive and juice up the yields. We actually want to try and make it quite sticky within the ecosystem. We want to make sure we are building, as someone said, the ecosystem to ensure that all the liquidity comes on chain, and then once you've got your yield and you've hit your limits, you just move the assets off to the next one. We're working very hard to drive this ecosystem, saying, well, once it's on chain, once we have that privacy, once we have that set of disclosure, and we're sort of building that yield, how do we keep it within the ecosystem? And we're sort of building, we're building lots of different structures and products around making sure that the cycle just keeps going round and round, and that we keep that liquid content because it benefits everyone. And actually, the ecosystem will thrive the more that the liquidity remains. So yes, I think that's quite an important point from foundations and blockchain specifically, saying we need to do more, not just about driving a higher yield. How can we maintain the continual flow of liquidity within these lending markets?
Okay, yeah, thank you. So we already spoke about what already exists in lending markets and what use cases we can rely on. But what's happening now, right? So what is something that drives this type of products forward, and what features can we expect to have in like 3 6 months horizon that we don't now, or that are early in the market right now that we expect bigger growth in the future. So yeah, Luis, maybe you can start with this one.
Yeah, think about the future of lending. Of course, we're talking. We are trying to everyone's trying to integrate real world assets somehow and bring DeFi into to serve as rails for what we use to call TradFi, right? What Garrett mentioned about the uh, uh, compliance is really important right now. Right? How do we um, how do we make it useful for institutions without them take having to get into risks that we as DeFi DJs we are okay to deal with. Um, there are some new architectures that are supporting that. Right, we see AVV4 HubSpoke architecture, and then Morpho V2 also brings a lot of innovation. Even Sky going with Spark uh, in an approach where you can segregate risk, and you can have environments where you can work with compliance. All those things are important, but I see important innovation also on the use case, or uh, the how we serve finance. And so stablecoin yield, of course, is something that's being explored a lot, and will become quite important. And it's very important um, for markets in the third world. Like, I'm in Brazil myself, so maybe Brazil we don't have all this problem, but if you go to Argentina, people use it to have use it DeFi just to be able to have their to have their money in dollar. But now they can get like real stable yield, or yield on dollars, and it's important to half of the world, I would say. So I would say those are the initial, but they'll give space for others to comment.
Any other opinions? Yeah, Gareth, please.
So for us, it's I mean, it's actually sort of linked to what Lewis said around the compliance side. Probably the biggest now. I mean, obviously we're a privacy L1, but the the compliance side of what we're doing is probably one of the most important narratives from a point of view of this selective disclosure. So privacy is good. Don't get me wrong. Privacy, everyone wants privacy. People, they're borrowing, they don't want to disclose what they're borrowing, what the assets they're moving, where the LPs come from. But there is an element of disclosure which still has to be made. So we're looking from a tech standpoint around this selective disclosure, whereby you can keep it private. It doesn't have to be on public chain. It was so it's going to be on chain. You've got the ZK proofs to validate the information. However, when it comes to compliance from a lot of the big institutions, they're very keen saying, well, we have to disclose the information to financial regulators. We have to disclose certain aspects of this information. So for us to sort of drive this forward as a key sort of infrastructure on what we're building, we have to enable this ability where we want to adhere to the demands of the ecosystem from the lenders, etc., that they want it private. They don't want all their trades and all their sort of lending criteria and the assets being publicly disclosed. But at the same time, we have to make sure we adhere to the government side, on the regulation side, on the financial side, where they want to have this compliance layer. So that's for us the biggest advancement is around being able to be compliant at the same time as keep privacy as well. And this selective from a midnight perspective is one of the key aspects which is driving us and getting that interest from from various banks. We recently signed Monument Bank in the UK, which is the first UK regulated SEA regulated UK bank around bringing on tokenized retail deposits. Now, the reason for that was because we adhered to this ability saying, well, we are compliant from a purpose of we're able to, or not us, sorry, Monument are able to selectively disclose from a regulation perspective, but also the deposits can be private. And that for me is one of the biggest advancements in this space to allow all that institutional capital to come on chain and start this market flowing.
You're muted, Andre. You're muted, Andre. Andre, you're on mute.
Hello?
No, I'm not. Yeah. Oh, yeah. Sorry. Do you hear me now?
Yes,
Okay.
yes.
Um, yeah. Yeah. So let's go further. And Ali, Salman, you are like representing now the borrower side in the lending marketplace. So, can you describe your holy grail, right? You already spoke a little bit about what you work, what you need, what you leverage in the ecosystem. But what you would love to see? What would be your dream feature now that you would like to see in the lending market sometime in the future? Is it something that you are thinking about? That I wish it was available to me today, but okay, I'll just wait.
Yeah, you don't mind if I go first, Salman?
Sure, sure.
Yeah,
Okay.
please.
Yeah, I've been thinking of this dream thing, and we're working on the backside to make it something similar. But in my ideal world, it would be kind of so our main I wouldn't say our main challenge is the compliance, right? Just to be very light on my explanation, Gareth, you were talking about privacy, right? So everyone cares about privacy, but not the governments, right? So what we need is like a box. Basically, we need to be privacy preserving at the same time that we can decrypt that information on a per use basis, right? So the governments can use it, and I'm sorry for the workers, they're still doing some noise. I don't know if you hear them. But yeah, so coming back to my dream product, it would be a compliance infrastructure that is chain agnostic, that has this encryption and decryption sorry, person we are trying to onboard. that will allow us to get to many distribution channels, as I believe the blockchains are, as possible, basically.
Right. Shall I go then?
Yeah, please go ahead, Solomon.
All right. So you've been asking about the ideal scenario. Look, everything evolves, and of course, when we start our startups or fintechs, we do set a vision that is of an ideal world. So when we set up, let's say 3.5 years back, when we were looking to start it, we wanted to solve the problem of invoice financing with the Web3 rails, stablecoin. Investors are also getting the opportunity to drive the yield from the real transactions and from the real economic activity. So that was the starting point, and now it has evolved to another layer of another receivables who are with the payment networks for their cross-border remittance lying idle in the nostro accounts. So we thought that okay, now we can solve that problem as well. So I don't think so there is a ideal solution or a scenario. It keeps on evolving as you evolve, as the market evolves, as the industry overall, especially the technology now also evolves, because technology is the foundation of the innovation we are all trying to bring in the sphere of finance. So the more evolution we will see, the idealistic scenario will be evolving. So yeah, that's my like take on the what would be the dream product. Of course, it would be the dream would be to solve the problem of investors getting the secured 100% secured yield, and at the same time on the other side, the borrowers getting on time on demand kind of a yield within with the click of button. But we are all pursuing towards that, whether we there were companies, banks doing it in the web 2 space. Now we are trying to take it further, one step further in the web 3 space. But that's the whole point, that borrowers get the liquidity on time when they require for their growth, and the liquidity sorry, the investors get the secured yields with the quick like turnaround.
All right. Any other dreams? Or we can go to my next question. All right. Yeah. So we have a little bit underrepresented other type of participants of lending marketplaces is liquidity providers. So I guess Luis, you are the closest one to the liquidity providers, and what do you hear as the marketplace participants? So participants, what do you think now? What do you think they're looking for?
Yeah, well, of course, things that I hear most are like options of you that are risk adjusted, right? And safe environments to invest. We are still dealing with some DeFi risks that are more technology related that we need to get rid of. Uh, one common problem is liquidity, right? How quick can I withdraw, and what is the utilization? With the problem that we've seen it in Aave, that people got locked very quickly just because everybody was withdrawing. Um, it gets even more complicated when we're talking about real world assets that have at least like 30, 60, 90 days payback. So um, transparency, who are the borrowers, what is the compliance here. And one thing that Ran mentioned that is really that's becoming really important is like fixed yield, fixed terms. So um, I think it's something that we really need products that go in this direction uh, for the capital allocators. Um, yeah, and then there's a problem that maybe Yahweh is dealing with these now is how the capacity, right? Okay, you can allocate 10 million, can allocate 100 million, can you allocate 200 million? So we want to serve a market that is giant comparing to what DeFi is now. So we need to get prepared to, okay, now we have market fit, how we scale that. It's gonna be a tough thing to solve.
All right. Yeah. Thanks, Luis. Um, all right. So, but in relation to that, my next question would be for Gareth and Ren, and we already touched about it a little bit. It's it's kind of elephant in the room about liquidity. Who is putting money in these ecosystems, right? And do you have any structured programs that work with liquidity providers to drive liquidity to the workloads, to the applications in your ecosystems, or you approach it on more on an ad hoc basis, case by case? So if you can guide us through a little bit of what capabilities exist in your ecosystem, I think our audience would love to hear that.
Okay. Yeah, I think I can share some of our approach. Yeah, so I think basically there are two kinds of LPs, right? One is, for example, institutions and family offices, high net worth, this kind of uh, investors who may invest 1 million or plus. And the other kind are so-called retail investors. And so basically, normally we need to solve the cold start problem. And I think the best way to solve it is to find the anchor LP who might, invest the 1 million, 2 million there, no matter it's a vaults USDC depositor or something like that. So normally the retails, they feel comfortable only if, there are several million already existing there. So the way how we find the anchor LP, we are working with some of the distribution channels. Like we've worked with Yield Network, Liquidity Land, Turtle, and many, you name it. And so after, for example, we find the anchor LP, basically we will start working with the retail distribution channels. For example, we are distributing the yields with Merkle by giving out incentive APY in PROS token, for example. And we are also working with OKX wallet and top knot wallets, BitGet. We are talking with all the major exchange and wallet solutions to run campaigns. So, for example, like pre-TG, actually, we ran a campaign with OKX wallet, and they've got 10 million, 20 million subscribed in 1 hour. So those exchange, they really have lots of retail investors. And if the APY of that product, for example, the lender APY reach double digit, I think it will be very attractive for those retail investors. But definitely we're also exploring some other ways. For example, as a chain ourselves, as a foundation, can we probably be the first one to seed the liquidity? So we are also exploring this with some market makers. For example, we also want to use our own platform token, for example, PROS, as a collateral to borrow USDC, right? And basically, it's more like a treasury management. And once we borrow USDC, we can help the DeFi protocols to grow. We could be the anchor LP ourselves. So those are the approaches we're exploring. Yeah, but definitely want to learn from you guys. Like, what's the best approach? Because we also need to solve this cost out problem for many of the DeFi's in our ecosystem. Yeah.
Yeah,
Yeah,
go ahead.
oh, sorry. Go on, Lewis. You want to jump in?
I just wanted to share two growth hacks that we believe in. One is what we're doing, right, is the credit delegation route that we are unlocking liquidity from Aave, and we'll do it with other big lending markets. We think it's a way to get liquidity that is sitting there and to serve higher yields. And the other, of course, is compliance with that will drag more investors, but it in a broader way. Sometimes it's not just legal aspects, right? It's localization. How do I make it compelling for liquidity providers in South America? Or what InvoiceMate was doing, like we have a share compliant product. It serves 1 billion people that are underserved. So I think those are two growth hacks that are very, really useful.
Yeah, just to quickly add, I think the ability from attracting liquidity providers is very much everyone's thinking about sort of the next solution, the best way to do it, and how to incentivize more. And obviously, from our perspective, we are trying to make as attractive as possible sort of the yields that you can generate, and sort of making the scope and the variety of assets you can purchase and sort of lend against. From a liquidity perspective, we are very close to and sort of developing new solutions around how to make it easier to bring liquidity across from other chains rather than to look at everything from various different bridges and etc. So the ability for us to move liquidity from other chains to Midnight in a privacy manner is very close to being sort of launched. And from that perspective, it will mean that we'll be able to enable a tremendous amount of retail deposits to come across without the retail user having to sort of look at what bridges, look at the fees, and then having to set up different wallets, etc. We're looking at this and building this solution to make it sort of simpler for these retail liquidity to come across and be able to operate in this privacy manner. And then from an institutional perspective, as I say, this sort of Ali mentioned about the dream of being able to offer the public and the private dual model. That's pretty much how Midnight's built. We have a dual chain model, which is public and private. So the ability to trade, to lend and to move and to offer transactions on a public sphere is possible. But then if you want to keep the information private, we have a private chain as well, which is held on your device. And then you just selectively disclose who has access to that. So it could be the government saying, no, you're only going to disclose this aspect to the government. So we have this dual model and the ability to then pull that liquidity off other chains and operate in a privacy manner. From us, it's no, we don't have to build individual bridges to each individual chain. We have a solution which will work, across lots of different EVMs and other chains as well. So we're looking very much at the technology aspect of how we enable all this to make it simpler and that adoption greater, not just, and obviously we're doing that with attraction as well of that institutional LP to come on chain as well. So we're taking a sort of dual approach.
All right. Yeah, we have 6 minutes to go, and let's take a couple of questions from the audience. I see the one that I think Mohammed will have strong opinions about, and probably Louis. So, invoice financing has decades of traditional TradFi history. Now, what does putting it on chain genuinely improve, and where it is just adding complexity?
Right. So I'll be quick. First of all, it's a alternative liquidity which comes from the Web3 side. There is now in trillions, so that routes to the conventional businesses, and that's one of the caveat for them that why they should be pursuing the players like us to get their invoice financed. Second, obviously, there is like a permissioned pool kind of a DeFi which provides the fractional ownership of the or not ownership, I mean fractional investment or liquidity provision for the invoice financing. That's another like added advantage the borrowers from the conventional world get from the DeFi like players who are bringing invoice financing on Web3. And as I said, everything evolves. So these were the initial two thoughts when we were bringing on chain invoice financing on chain. But the more we are progressing, there are more like solutions or features which are connecting both sides and giving the benefits to both sides.
Well, my opinion is the one of the biggest wonders of DeFi, that is yield arbitrage, right? In Brazil, if, for example, we pay a business here to get invoice factoring, they pay 30 to 40% a year, and it's normal. And we are one of the most stable economies in Latin America. We have controlled inflation for the last 30 years. It's 5% for an average, and for the last 30 years. So it's still people are paying outrageous born rate. So if we can have someone in Japan that wants to lend to someone here, and it's so, and governments make it too complex so that you cannot do that, and banks don't want you to do that. So DeFi is a way to break all those walls, and it's and I think it's actually wealth distribution. It's opportunity for all the markets.
All right. Yeah, I have actually a spicy one here. In 3 years, on-chain credit infrastructure belongs to BlackRock and the banks, not us. Who at this table is willing to bet that's wrong? Everybody agrees. Okay.
Yeah, I think the with the DeFi becoming more mainstream and all the legal frameworks starting to make it, like the Clarity Act, and it, of course, those big guys that are really taking care of the compliance side will benefit first. But DeFi still makes it open to everyone, right? And just as in TradFi, there will always be space for niche strategy. So the Black Rocks, the big banks, they don't want the niche because it's too expensive for them to deal with. They want the big retailers. So I think the competition will be similar to what we see in TradFi, but yeah, maybe there is some demand shock once things get integrated.
I mean, and it's hard to not agree on that if you just check the kind of numbers that right now in 2026 we already have regarding real world assets on chain, and they are very concentrated between these guys, right? Like the 60-70% of the volume is because of them. And not only that, they are not only conquering on chain, but like in TradFi, real asset, sorry, real estate market is also conquered by them.
Okay. Uh, Other opinions? So, Mohammed, Ren, Gareth, so you essentially agree, right?
Yeah, I think as Ali mentioned, you look at the numbers, it does. But I think as naturally the industry evolves, the it will start to filter down and filter through. We just need to make sure it's easier for that liquidity to filter down, filter through. And I know there's an aspect of the transparency and the DeFi side is around we don't want to share and show the information of the trades. I think the ability to enable technology to make it easier to satisfy both ends, I think that's going to help sort of grow the space and bring that adoption. But obviously they have tremendous amounts, but it's trying to make it easier to have that flow through into to the other players. So.
Okay, yeah, time is up, and thanks everyone for joining today. Please, our panelists, spend some time review the questions that were asked by the audience, and maybe provide your answers. And the final round, just I don't know, one sentence from everybody. We didn't touch about AI today, so and every conversation should touch AI, right? So speaking about lending markets, do you think at what extent they will be affected by agentic users? Will be dramatic shift? Not that much. So what's your opinion?
Okay, let me go first. For um, the scale, just give me like it will outnumber the amount of transaction and the volume of them on permissionless lending markets. On permissioned one, like for example, Fuero, it won't change.
Okay, Gareth.
Yeah, I think it will change hugely, but sort of I mean, we're looking at the next iteration of obviously you have KYC and KYB and AML checks. We've got KYA, which is know your agents. So the ability to have personalized agentic solutions that will trade on your behalf and have everything from we're looking at this sort of open wallet standards around allowing agentic solutions to trade on your behalf and to be able to borrow and lend on your behalf. I think it's going to have a massive impact on the market. And I think it's for us to enable so in a way the guardrails to ensure that it's done in a very fair and compliant way, so it doesn't offer increased risk to the market. And I think it's up to all of us in here to make sure we're looking at all aspects of that to make sure it's developed in the right place, the right way.
Yeah, I'll definitely reinforce the point of Gareth that the world has come to the agentic AI age, and in the business of lending, all three types of agents are now coming up. It's those who are assisting the borrower side, those who are assisting the investor side, but importantly enough, there is a big value of agentic AI assisting the overall operations of the lending, starting from onboarding to the due diligence, then the disbursements and the recollection, every aspect of the operations when it comes to the lending. So we as a project, we've been working on all three agents, been live, and but it's just raising a baby kind of a thing. Any agent will grow as much as you are feeding or enabling the feed of the data or scenarios to that agent. So don't expect that the AI agents will take over the world of lending in quick time. It will still, I see, 2 3 years from now that their role will be prominent in the space of lending.
Yeah, Red.
Yeah. So actually, there are some agent curators or AI agent curators who are leveraging AI tools, reaching out to us, and we are definitely welcoming them to try this idea. Yeah. So from my perspective, I think it's eventually still a tool. So basically, you need to be the expert who are training those models, and basically, I think we need a human plus an agent to manage all this kind of stuff. But one thing that might be interesting is that I think in the blockchain space, actually, we have smart contract. So we have this automatic alert system, and we have, for example, hypernative and this kind of security firms. So actually, they can. So normally, the risk curator's job is that they need to manage and monitor the risks, and they need to liquidate the collaterals, right, when the price dropped to a certain level. And sometimes, for example, the curators was asleep when something happens, so it took them 3 to 5 hours to really get up and sign the multi-sig wallet and liquidate the assets. And it happened a lot for many times including helpdao, right? So actually some security companies plus smart contract solutions could solve this issue, but I think it's not because of the technology, but because of the company policy, right? So they don't give the authority to those smart contracts or the firms to basically monitor and directly execute the transaction. So I think it's really aside from the technology itself, I think the governance and policy, this kind of human related stuff in the DeFi protocol is really important. So we need to redesign all these policies and execution rules, according to the what the agent needs, and like how much authority we should authorize them to do. I think that's really a part that is missing. But I believe in the future we'll figure out a way to leverage AI agent to monitor risks and curate the lending market.
Okay, yeah, Luis, please close it up.
Yeah, I think in the short term we're not prepared yet to hand over the keys to the agents end to end, right? But then we will see in 3 to 6 months we will see them like making the markets, the DeFi, much more, and the lending space much more efficient, because they will be monitoring health factors, moving refinancing, moving deposits, and like more for just in April they launched the MCP. So like in the short term, they will be able to interact with all lending markets, and they will help us with let's say to make it more efficient. But I would bet that in 1 year we will have them as like real bringing workload, like uh, managing and allocating and making decisions. We had the discussion with with a professor in Cambridge that and he was saying like what we didn't get yet is that the AI revolution, the agents and LLMs, they are made to make better decisions than humans, and we will understand that, we will give and we will hand over the keys eventually.
Awesome. Yeah, thanks everyone. Thank you guys for joining us today. Mohammed already had to leave to his next meeting. Yeah, so thank you so much. Awesome discussion. Hope to see you again.
Thank you.
Thanks.